Well, good evening, everybody. It's Blair Nightingale here. We took a couple minutes just to log on there for some reason, having a technical issue, but here we are. Only 1 minute past the hour, 6 p.m. It's Central Time right here in Texas. YouTube for our friends at Tradeway, right? We are Tradeway. My name is Blair Nightingale. Facebook, YouTube, wherever you're coming from tonight. Glad to have you guys on here. Always a pleasure. We've had a lot of just really great shows, good questions lately from folks. So I'm really, really happy to be able to do this again tonight and just continue to update you, give you a resource every week to check in and say, hey, what's going on with the markets right now from an investing and from a trading perspective? Because there's a lot of stuff going on, right? A lot of the time over the last few years, what we've done on Market Monday is we've had specific topics that we wanted to go into in a series or even just a one-off. And we haven't been doing that for a while now because we really want to just stay connected to what the market is doing week to week. You know, we had that bear market in 2022, and then this year we get that big bounce almost back up to the highs that we were at in late 2021 to see this volatility come back in now and start to move back down. Now we're somewhere in the middle. I'll talk more specifically about that off the chart here in a second. But a lot going on in the economy, a lot going on in our country. We've got a political cycle coming. You know, the ratings, right? The approval ratings for the president, no matter what side of the aisle you're on, are pretty low. In fact, they're historically low. And a huge part of that is the economy. Okay. We had a great economy. Of course, COVID came in, the way that was handled, and we're just not in a good spot here. We're not in a good spot. To be fair, you know, doesn't matter who's in the White House. I would not put all of that on whoever was or was not in the White House. Because the Fed actually had a job to do much earlier on with inflation. And in my opinion, they simply failed to do that. Okay. They told us over and over again that inflation would be transitory. It's just transitory. And of course, that was not true, right? That low rate environment, cheap money, was something they wanted to hold on to. A lot of Wall Street, a lot of people wanted to hold on to that for a long time. We're not in that environment anymore, guys. So we're watching the markets pretty closely. Now, that said, even though, again, we have normally gone over a specific topic, options, you know, managing risk, patterns, all kinds of stuff like that. Tonight, I do want to go and just review some lies that Main Street is told by Wall Street. Okay, I meet people around the country every weekend. And when I show them these things, almost overwhelmingly, it's the first time they've ever heard it in their life, which of course was my story back in 2015 when I first went to a class that Tradeway had in Philadelphia in February of 2015. But it's almost unbelievable, almost unbelievable for people because they have so bought into what Wall Street says is the only way to do things. The financial industry in many ways. Not in all ways, but in many ways. So I want to talk about those tonight as we look forward. Are we going to have a recession, right? One of our other coaches in the Tradeway program said today, he said, do you want to hear that it's going to be bearish or do you want to hear that it's going to be bullish? You can always find somebody to tell you what you want to hear in the market. There's somebody who's going to pick a different side, right? So we don't know the future, but we do know the signs of the times. We do know the conditions. And the conditions right now, okay, are definitely deteriorating. Okay, they're holding up more than people thought they would, but they are deteriorating. I said to another coach on the weekend out in, I was going to say St. Louis. That was 2 weeks ago. Kansas City this past weekend. We've got Joseph saying he lost the sound. So it's looking good on my end here, Joseph. So I don't know if there was an issue on your end, it muted or something like that. Somebody else can let me know in the comments if you're unable to hear me at this point. Looks good on this end. I said, it still feels like that there's still a lot of people, there's just fingers plugging holes in the dam. We're not going to predict on here, the date of a recession at any point. It's going to be this, it's going to be that. A lot of bears were very disappointed this year. What my intention tonight to benefit you guys who've chosen to spend a little bit of time with us here is to give you a few things to think about as you go forward, even though you don't know there's going to be a recession at next week, next month, next year, even time point. So we can prepare even though we don't know exactly when, is what I'm driving at. And there's some things I want you to have in mind because it can create security, safety, even opportunity. Okay. So that's really important. But the first thing I want to do is just look, we notice here in the market, this is one of the things I want you guys to think about doing. As you are learning technical analysis in the markets, traders, you're not learning technical analysis so that you'll know what the stock is going to do. This is very important. You're not learning technical analysis so that you can learn what the stock is going to do. There's no way for you and me to use technical analysis to know what the stock is going to do. However, you are going to use technical analysis to manage the risk when the stock gets to places where, even though we don't know what it will do exactly, we know what it is likely to do because it happens over and over and over again. And I'm going to give you a very easy example right now. You see this trend line I have drawn here on the S&P. You've got these highs, these lows, the low, right? And then you've got right here. And actually last week we even had a line pretty much right up there, right? That's a little bit tighter. But you can see it broke through that. Now we had students looking at the downside here, puts, okay? Put options. Put options increase in value when the stocks move down. It's inverse. It's an insurance policy. Put goes up when the stock goes down. That's how that works. But why? Why did the stock market turn right there? Could we have guessed? Could we have known, right? That line right there, right? Well, we wouldn't have been able to crystal ball it, right? We wouldn't have known for sure. Yes, it's going to turn. I swear it's going to happen. No, traders don't do that, but good traders do this. There's a level there that's really important to watch. And whether or not it goes back up or continues down or not is yet to be seen. But the individual, the trader with risk on the table, is able to go, I have a plan at that point in time. My eyes are open at that point in time, not because the market can't change at any point. It can, and we can't be prepared for every single thing, but we can I should say that differently. We can see the market turn at places that we didn't expect it to turn, of course, right? Some of it is news driven. It's not about the price on the chart, but we can have an expectation of major points. Now, these support lines here are certainly one of them, but I want to show you this, okay? If you look at this blue line here, that's the 50-day moving average. It's just an average that's plotted on the screen. By the way, if you're out there and you're learning, you're investing, or you're trading, and you're not looking at the moving averages, or what we call exponential moving average, EMA, I highly recommend that you begin to use them. Now I have 5 on my screen. You may not have 5. For my longer term people, I've got those dotted lines, that 100 and 200 day moving average, Shorter term, I've got a 10, 20, and 50, the good old red, white, and blue there, okay? But moving averages are hugely helpful. They're psychological, okay? I use them, you use them, Wall Street uses them. And because we all use them, okay, they become a self-fulfilling prophecy. We sell at the moving averages. We buy at the moving averages. If I think you're going to buy at the moving average and I think they're going to buy and they're going to buy and they're going to buy at the moving average, what might I do? Buy at the moving average. And now we're all buying at the moving average, and you bought at the moving average because you thought I would. It happens over and over and over again. And it becomes a self-fulfilling prophecy, which then what? Makes us pay attention even more, which makes it work. So they really are powerful in that sense, okay? And what I want to show you is that blue line here is the 50-day. But if I change my chart here, I can use the software to move into a 50-week line. 50-week line. Now, it's slightly below that line last week. This was Wednesday, I believe, of last week. This stock, this is the S&P 500, of course, this stock index, went down and hit the 50-week average almost perfectly. Okay, almost perfectly. So did we know it was going to turn at that direction? No, we didn't know. But if we had the skills to go, hey, I know what's important and what's not when a stock is moving, I just keep it on the radar. Oh, if this bounces at the 50-week, this is what I'm going to do. I have a plan. If this breaks down through the 50-week, okay, then I know what I'll do there. This is why I tell you guys some of the major news items that are coming on the week. Okay. Not because we know exactly what the news will do. See, some people come on here and they go, well, the Fed's going to come out this week and they're going to say this, and this is what's going to happen to the market. It's going to do this. Well, that's a guess. That's a guess at best. Okay. They may make it sound like it's not, but it's a guess. Because the job of the trader is never guessing, gambling, or going for it. The job of the trader is to assess volatility and manage risk. News helps us assess the level of volatility. I would rather expect higher volatility and not get it, okay, on a directional trade like a stock or an option. Some trades need volatility. They're designed to capture huge volatility. Okay. All stocks plays a stock. We buy a stock, it goes up. We need some movement, right? Options, long calls, long puts, those need some movement as well. But the news is really to identify what's the volatility level. So that's why I tell you guys those things, not because we're going to learn what the future is or that we can always correctly guess, right? We don't need to do that. What we want to do is assess the level of risk that's coming. Hey, 50-week moving average is coming up. I told the students on that day, I didn't know. It's just a matter of watch for that line. Watch for that line to see if we get a reversal, okay? And then we did, which could mean profits given back in put options. It could mean a setup that you want to take on the upside. Right? There are different reasons why. Maybe for some people, this particular reversal wasn't that big of a deal, but it's a skill set. It's something they keep in mind to go, okay, I'm going to continue to just keep these things in mind. Okay. There were specific lines on the 3-minute chart today on the S&P, right, that were very, very important. 4,300. The market went up to 4,300 and tanked 30 points off of 4,300. Is that because I knew, 4,300, that's it? No, it's because it's an important resistance level. It's a round number. It's a psychological level. 4,300 is important. Does that mean it always falls and drops off of those big round numbers? No, not always. But you better believe I keep them in mind. If I'm looking at an intraday chart, big round number like 4,300, I'm going to keep it in mind. Okay. So these are just some important things, and it takes us into what we're talking about. Okay. Tina, am I seeing an M or a head and shoulders? Really, what we're in right now, Tina, what you see on the screen there, we're really in a downtrend. Okay. We're holding in that support level. We haven't really been able to, catch much of a move upwards so far. Okay. Now you're looking at a weekly chart here, remember? Okay. But we are looking at a beginning of a downtrend here. Now remember, like if we're looking at an M pattern, we're going to have equal highs on the top. Okay. Now we may not always have that, but you'll double top and then you'll break down from there. Really, you'll look for a move below the middle of the quote M, which is really what it did from this point down into the 50-week moving average, which now it's reversed and it's holding. It didn't really do a big snapback here, right, where it's dramatically turned around, but it's definitely holding and finding some support there. It's good to ask yourself, when the S&P is in a pattern, we don't know what each day will be necessarily, but is it closer to resistance or is it closer to support? That's helpful to know. Okay. Because why? Because we can assess risk. If I'm closer to support, hey, I might short something, but I got to know the market is closer to a level that it bounced at last time. So I want to keep that in mind. See, I don't know the future, but data is there to help me manage risk. The person who goes in the casino and counts cards, they're no longer gambling, right? In some sense, of course, they don't know what the next card. They don't know what the hand is going to be. They can't guarantee the next win. But what they can do is understand the mathematical probabilities of getting the card that they want. And if the probability is higher that they're going to get the card they want, then they will bet higher. If they do not think they're going to get that based on math, then they will make the bet lower. Okay. The position size changes, but it's no longer just flying in the dark, assuming one actually has a skill set. But I will say this, the casino is so confident of an advantaged player's skill set, they will kick them out. If it wasn't possible to do, I don't think they would care. In fact, one of the things they watch for is somebody who bets small, 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 big, big, small, 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 big, big, right? Because it's a signal. Oh, this person has some way of defining where to have activity and where not to have activity. And even though we're not playing cards, about to lose my computer here, even though we're not playing cards, okay, we are looking for no, 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 yes. No, 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 yes. Is it because we know the future? Okay, last time I'll say it. Of course not. It's because we've learned to identify pivot points and risk. Is it closer to support? Is it closer to resistance? Certainly, that will help us assess risk. Okay. Now, I said this is something that'll take us into a topic that I wanted to just hit on tonight, that I say every weekend. It comes up every weekend. Okay. What's the norm for most people in terms of their exposure to and connection to the stock market? Well, typically speaking, it's two things. One, maybe a little bit of news on the nightly news, online. Stock market goes up, stock market goes down, stock market at all-time highs, stock market crashes. That's it. The rest of it, mostly mystery. But at the initial point, it's just a news item. And it seems like, well, it's a good thing when it goes up and it's a bad thing when it goes down, and there's not a thing we can do about it. That's typical. Okay. That's number one. Number two is through some kind of an advisor or a 401k program. Your company will hire an advisor and they'll administer a 401k program. You get to sign a couple of papers and say this is going to be aggressive or it's going to be conservative or somewhere in the middle. And that's it. We don't even know what's in it. We don't even know what they buy. We don't even know what they manage. We may not even know whether it's doing well. We figure, well, somebody else is being paid to do it, so I guess I ought to just let them do it. So here's 3 things I want you to be aware of. We've got some folks on here tonight that are a part of our program, and these are some things that you've already been initiated. You're thinking about this. You understand that you're going to have to take some control into your own hand, empower yourself so that whatever path you choose to move forward with your own finances, you have more of that perspective. You have the ability to know what to watch for. Again, not because you know the future, but because you realize it's up to you to manage that risk. Because, hey, how well does a typical financial advisor manage the risk for you? Well, I will just say this not on opinion. I have opinions, but I'll say this based on the fact that I've been to probably over 100, even 200, maybe even 300 plus meetings with people all around the country over the last 6 years. Okay. And I have yet to meet anybody who said, when the market crashed in 2000, when the market crashed in 2008, when the market crashed in 2020, even we had volatility with some pretty significant moves down, even though there weren't major bear markets at other points in that's over 20-year time frame. Nobody got a call from their financial advisor. Okay. Maybe somebody out there did today, right? I'm not saying that's never happened. But for me, I've not met someone who says, "Oh yeah, I got a call. And they said, "Hey, this is our comprehensive plan. This is exactly what we have for you. These are your different options of what you could do to protect what you've made." You went through the 90s .com bubble, and man, you've done really well. So we just want to give you some options on how we might be able to protect that. We won't be able to get perfect. We're going to lose some money. There's no way to not do that, but here's what we can do. Well, that didn't happen. So, in the .com bubble up to 2007 into 2008, we actually went back up. Here, let me show you. I'm going to show you on here. Let's go to maximum. We'll take a weekly chart. So 2008, well, here, look at this, guys. What's this right here? 2000. Well, what happened in 2008? We went right back to the same level. Okay, so sorry. We didn't really have a plan in place for you in the .com bubble, but here we are, 7 years later, and we've actually made it back. And I told you, hey, it'll come back, right? Who's ever heard that before? Hey, it'll come back. It'll come back. Okay, so it came back, but now we've done really well again. Now we had to obviously recover. So we didn't do as well this time as we had done in 2000. But here's the plan. We can't time it perfectly, but we're trying to manage some risk here and lock in some of what we were able to get for you in this last 7 years. Okay. That didn't happen either. Right? So 2007, 2008, 56% gone. Now, I want you to think about something, guys. When you lose, okay, it takes more to get back to where you were. If you have $10 and you lose $5, how much did you lose in percentage? 50%. 50%. You took a 50% loss. Okay. Well, what happens to get us back to 10? You need a 50% gain? No, you need 100% gain. So it's always more to get back to just where we were when we lose that much. Okay. Now you'll also notice on the chart, this thing is screaming higher. This is all the cheap money, folks. This is artificial. And you could say, well, artificial, smartificial, right? Doesn't matter. I made great money in there. And if you're in a retirement age in that period of time, then you would have benefited from that low interest rate environment. Quantitative easing. By the way, guys, the pickle we're in right now, the unbelievable amount of debt that we're in, the deficit we're in, the balance sheet of the Federal Reserve, which over 40% of the balance sheet of the Federal Reserve has been added since 2020, spiraling out of control. Am I saying our economy is going to collapse tomorrow or next year? No, I'm not making predictions, but I will tell you, if we did in our household finances what the United States government does with theirs, we would be in serious, serious trouble. Okay? It is absolutely out of control. If you don't believe me, you can go to usdebtclock.org right now, and it'll let you know exactly what I'm talking about. There's plenty of other things we could be looking at here too as well to see where things are at. Credit card debt, home ownership, default on credit cards, default on auto loans, rising, I can't think of the word, guys. I will think of it in a second. It just jumped out of my head. There's a lot of those things happening. My point is that this just went bananas, right? Which, begs the question, how come I see people's accounts out on the road when I'm visiting cities around the country that are just getting absolutely hammered? Over 90% of the mutual funds that are purchased by folks from Wall Street don't beat the market index. If we went out and bought something like the SPY that just tracks with the market index, how many times would we be better off just doing that, which wouldn't require somebody else to buy it for us at all? So 2008 comes and goes. Well, there's no plan there, right? Massive, massive stimulus in COVID sends this thing straight up. This went from 785 to 1550, okay? A little over doubled in that time. Took 7 years. This went from 2,200 to 4,800, okay? 2,200 to 4,800. So more than doubled significantly. That's March 2020 to not even March 2022, December 21. That's a year and a half. That's artificial. So all this to say, folks, when Wall Street says, hey, the only thing you can do is just hold it to the bottom. There's nothing else you can do. There's no other plan. Here's what I would submit to you. You can chew on it, think about it, and you can decide whether or not you agree with me or not. Wall Street can tell Main Street to hold it to the bottom all they want. But I'll tell you what Wall Street doesn't do, you guys. They don't hold it to the bottom. How do I know this? How can I say with 100% certainty that I am not incorrect about that, that I am in fact correct about that? Because the market moves down. 80+% of stock that is owned on Wall Street is owned by the institutions, the banks, the mutual funds, investment banks, of course, pension funds. When they sell, the market declines. They're the big money. They're the ones that make it decline. Of course, they also short the stock, which is just more selling. Okay? So they sell and tell you and me not to sell. Interesting. When risk gets higher, they sell. Right? So this is something that's really, really important to look at. Okay? What we have to do is go, all right, even though I can't know the future, I can't time the market, I definitely want to have ways to manage risk. I'm going to suggest something to think about right now. We're not going to get into this tonight, but Wall Street has designed options to be a hedge against downside stock risk. That's what a put option was created for. Okay. The wealthy use it. Wall Street uses it. Warren Buffett uses them. I told somebody this on the weekend. They learned, they took a class with puts in it, put options. And they said, I'll just be honest with you, Blair. It's hard to believe that this would even be real. Not like, wow, that's really cool. It's hard to believe. No, but actually, like, I'm not sure I believe this is true. Like, I'm not actually sure this is real because there's a cognitive dissonance. What you're telling me is that there's been this thing the whole time. It's not perfect. It's an insurance policy, but it's been there the whole time. And no one has ever told me about it. No one has ever talked about it. No one has ever offered it to me. And those 2+% fees that I'm paying that aren't supposed to be very much, that actually over the long term are massively eating into my retirement returns. They go to Wall Street, not to you. That person never told me either. It's actually a really big deal. It's actually a really big deal, right? So, learning how to do this for yourself is not as outrageous as some people. Really, two groups. One, Wall Street. When you don't know what you're doing, guess who you need? Them. And it's very easy for them to convince of that. Okay. I'm not saying there aren't smart people on Wall Street. I'm not saying there aren't good financial advisors. I'm not saying there aren't appropriate times for help. I'm not saying that these are all terrible people. Okay. What I am saying is anything in life where we're not educated, it's very easy for someone else to have all the power. Very easy. Okay. Education is a good thing. So that's number one. The second thing is that honestly, friends, family, neighbors who avoid this stuff like the plague, they're not much help either. We love them, but they're just not necessarily, in many cases, not all, but in many cases, they're also, no, you just do what is normal. You do what is common. There's just some things in life that once we start stepping outside of what is common, what is normal, what is expected, by the very nature of doing what is unexpected and uncommon, it is threatening. It is discomforting. It is strange. It is weird in the truest sense of that word. So we don't always get much help there either. We have to kind of blaze that trail on our own. And certainly around here at the Tradeway community, we know that and we know what that's like. But learning how to manage, learning how to talk to a financial advisor at the very least. I'll close tonight with a story. One of the other coaches here at Tradeway, he's actually a doctor here in Dallas. And I used to travel with him. We'd teach some classes. This is years ago now. And while he manages his own money, his folks, his parents are older. This gentleman is older than I am. And they don't want to get rid of their financial advisor. They don't want anything to do with it. They got their guy and that's it. They're just not willing to go any different route. But what they are willing to do is have their son, right, this other coach of ours, go in and talk to the financial advisor himself, I should say. And when he goes in there, I was told this story by this gentleman firsthand. When he goes in there, the financial advisor starts to sweat a little bit, not because he's, aggressive or mean or whatever. No, the guy just said to him, sir, I get nervous when you come in here because you ask me questions that nobody else asks me. And hey, wouldn't it be nice if all the folks under the sound of my voice tonight, watching, recording, say, you know what, I want to get to a place where I know enough, not that I'm trying to make people nervous, but I know enough to ask good questions. And I say this all the time. It's a true story. Good questions bring good answers. So educate yourself, empower yourself. If you've never taken the Step 1 Start Your Journey course, trust me, now is a very good time to do that. We've got one coming up this month in October. You go to tradeway.com events to sign up. Step 1, start your journey, tradeway.com/events to sign up. Would love to have you. Be happy to see you there. All right, guys, a little bit different tonight. Appreciate you. Glad that you were with me. Potentially, this conversation we just had may be one of the most important financial discussions that you hear out of the next 5 to 10 years. That's a true statement in terms of how much conviction I believe is necessary in this hour to say, I'm going to know what I'm going to do, even though I don't know what the market is going to do. I appreciate each and every one of you. As always, thanks so much for being here. And of course, my name is Blair Nightingale. I'll be back with you guys next week on Monday, same time, same bat channel. Appreciate you, and good night.